What are the benefits of a high debt service coverage ratio, DSCR? Have you ever wondered how some real estate investors seem to thrive while others struggle? One key factor that sets successful investors apart is their understanding of the debt service coverage ratio. So, what are the benefits of having a high debt service coverage ratio in real estate investing? Let's break it down. A high debt service coverage ratio indicates that a property generates significantly more income than what is needed to cover its debt obligations. This is great news for investors. First, a high debt service coverage ratio means lower risk of cash flow shortfalls. When the net operating income exceeds debt payments comfortably, it reduces the chances of struggling to meet mortgage or loan obligations. This ensures a more stable cash flow and financial security. Next, let's talk about loan approval. Lenders typically prefer properties with a debt service coverage ratio above 1.25. This signals a lower risk of default. Properties with higher ratios are more likely to qualify for loans with better interest rates and terms. This is especially beneficial for investors looking to expand their portfolios while keeping financing costs down. Another advantage is greater investment flexibility. A high debt service coverage ratio gives investors a cushion to manage unexpected expenses or vacancies without jeopardizing debt payments. This flexibility supports long-term investment stability and makes it easier to hold onto properties during economic downturns. Now, let's consider property valuation and marketability. Properties that show strong income relative to debt obligations are often valued higher by appraisers and investors. A high debt service coverage ratio can make a property more attractive for resale or refinancing, enhancing overall investment liquidity. Lastly, a high debt service coverage ratio supports growth and portfolio expansion. Lenders focus on the property's income rather than the investor's personal income when considering financing. This means a property with a strong debt service coverage ratio can help investors qualify for additional loans, facilitating portfolio growth. In practical terms, a debt service coverage ratio of 1.25 or higher is generally considered good. This means the property generates at least 25% more income than needed to cover debt service. This margin is a key indicator of a property's financial health and is critical in investment property analysis and management. In essence, a high debt service coverage ratio provides real estate investors with a safer, more attractive investment. It eases financing, supports stable cash flow, and opens up growth opportunities. Understanding this ratio can truly make a difference in your real estate investing journey.